Here's a chart that goes up and to the right. Paper traded. I'll say that every time. And here's the uncomfortable question I spent months building a tool to answer. Does this line go up because I'm good at picking stocks? Or because the market went up and I was simply in the room? Because if it's the second one, I haven't built a trading system. I've built an expensive way to be long the S&P. I'm Sandbox Theory. I'm building a hedge-fund-style algorithmic trading system by myself. US large-cap equities, paper traded through Alpaca with a human confirmation gate before any live order goes out. This channel is the honest logbook of that build. No Lambos, no signals for sale. Today is the episode the whole project was pointing at. Every other module, the data pipeline, the back tests, the execution logic, exists to eventually pass one test. That test is called performance attribution. It takes my realized returns and splits them cleanly into the market carried me, a style tilt happened to pay, and actual selection skill. And then it tells me whether that last piece is real or whether it's noise. By the end, you'll be able to look at any strategy's returns, mine, a fund's, your own, and ask the one question most people carefully avoid. Let's start with why the green line is a liar. Imagine my book returned some amount over a period. Good, right? Now put the market's return next to it over the exact same window. If the market was ripping, a big chunk of my return isn't mine at all. Anyone who was simply invested got that. That's not skill, that's weather. The technical name for how much I move just because the market moves is beta. If my beta is around 1, then when the market rises, I rise with it, automatically. So the first thing attribution does is subtract the weather. It asks, of everything I made, how much did I make purely because I was exposed to the market going up? And here's the trap that catches almost everybody, including me on a bad day. In a bull market, being wrong but leveraged looks identical to being right. The line goes up either way. Until you separate the market's contribution from your own, you literally cannot tell the difference between a stock picker and a person who is just long. It's hard to tell. You cannot tell. The information isn't there yet. So the module runs a regression. Don't flinch. Conceptually, it's simple. It takes my book's realized returns and explains them using 2 kinds of ingredients. Ingredient 1, the market. Ingredient 2, the style factors. The well-documented spreads that quants have measured for decades. Momentum, value, quality, size. Think about what a factor actually is. Momentum is roughly stocks that have been going up keep going up on average for a while. If my portfolio happened to be tilted toward high momentum names during a period when momentum paid, then some of my return came from that tilt, not from me cleverly selecting individual companies. Same idea for value, quality, and size. Each is a known generic tilt that you can get almost mechanically. So now the return splits into 3 additive pieces, and they add back up to exactly the total. That's the whole point. 1, beta, money I made just because the market rose. 2, factor, money I made because a style tilt, like momentum, happened to pay during this window. And 3, the leftover, the part the market can't explain and the factors can't explain. The residual after you've subtracted every generic reason I might have made money. That residual is alpha. That is the only piece that could possibly be selection skill. Me picking this company over that one and being right for reasons that aren't just the market or a known tilt. Everything I've built is, in the end, a machine for trying to make that third bucket positive. And I want to be really precise about the humility here. A positive alpha number by itself still isn't proof, which is exactly the problem the next section and the next episode exist to attack. Say the residual comes out positive. Before I celebrate, the module puts a t-statistic on that alpha. In plain English, the t-stat asks, given how noisy and bouncy these returns are, is this alpha distinguishable from 0? Or could a number this size show up by pure chance from a manager with no skill at all? Because a small positive residual over a short, jumpy sample is exactly what randomness produces all the time. A high t-stat means the signal is loud relative to the noise, harder to wave away as luck. A low t-stat means, sit down, you don't have the evidence yet. And then the tool prints a verdict, in English, so I can't hide behind jargon. It says one of 2 things. Either, selection alpha is positive and statistically significant, or no significant alpha yet. Your return is explained by beta plus factor tilts. I'm not going to stand here and tell you which verdict my paper book is printing today, as if it were a finished, audited result, because it isn't one. I have no multi-year, audited, live track record. What I have is a tool that refuses to let me confuse a rising market for my own genius. That refusal is the entire value. So let me be blunt about the limits, because that's the brand. First, attribution is measured on paper-traded results. Paper. It doesn't include every real-world cost and friction a live book eventually eats. Second, this might not beat an index. A perfectly reasonable outcome is that the honest verdict stays no significant alpha. And if that's what the evidence says, that's what I'll report, out loud, on this channel. And third, the deeper one. Even a positive, significant-looking alpha can be an illusion if you went looking for it hard enough across enough experiments. If you run enough tests, something will look brilliant by pure luck. Attribution answers, is it skill or is it the market? It does not, on its own, answer, did I fool myself into finding this in the first place? Which is the most dangerous question of all. And it's the whole next episode. The attribution code is in the repo, linked below. The regression, the 3-bucket split, the T-stat, the plain English verdict. If you tear it apart and find something wrong, that's a gift. Tell me. If you want the honest version of this build, the version that shows the tests it fails, not just the charts that flatter it, subscribe. Next episode is the signature one. How I stop myself from fooling myself. Multiple testing, data snooping, and the statistical haircut that takes a result that looks significant and quietly makes it evaporate. It's the tool whose entire job is to deflate my own excitement. Beta is weather. Factors are tilts anyone can buy. Alpha is the leftover, and the leftover has to survive a T-stat before I'm allowed to be proud of it. See you in the next one.